There's the keeping track of everything, and then there's a lot of people out there who that is a huge problem for them. But the second problem then becomes like, okay, what do I do? Right? Like I have all this stuff and all these different exchanges. Do I buy some? Do I sell some? Are there certain times of the year? Should I sell right before the end of the year? How do I harvest loss? Like all of these very complex things that in traditional finance, either there's financial advisors that are helping people do it, or they're professional traders, right? They actually are spending all day long thinking about this. In crypto, that doesn't seem to be the case in many cases. How did you guys, one, think through that, and two, try to help solve that problem?
Yeah, the good news is, we don't have to reinvent the wheel. There's lots of very intelligent people who have been thinking about this outside of crypto, for regular finances for a long time. And many of those things and those strategies and tools can be built for the crypto ecosystem. And that's a lot of what we're doing. There are certainly lots of new sort of nuances and idiosyncrasies about cryptocurrency specifically, and that is what makes it challenging to build a tool in this space, but also what makes it really valuable. So I'll give you some concrete examples. You mentioned like figuring out what times of years you might want to make transactions and using strategies to basically optimize your portfolio. So one thing that CoinTracker offers that can help people save a lot of money, I've used this myself to help save tens of thousands of dollars in capital losses, is basically using tax loss harvesting. And for listeners who might not be familiar with that, basically, before I go into this, just take that this is informational only. It's not meant as tax advice, but there's basically a tax rule that will allow you to sell a cryptocurrency asset that you have at an unrealized loss and then buy it back. So the effect of that is you maintain the exact same cryptocurrency positions as you have before, but your tax bill is lower because you've internalized and realized a loss that happened. So just to make that even more concrete, let's say you bought Bitcoin at $10,000 a coin, prices dropped to 7K, you can sell the Bitcoin for 7K, realize a $3,000 capital loss, and buy back the Bitcoin. You have the same one Bitcoin, you have a $3,000 loss, and you can use that to offset other capital gains, or if you have net losses, even ordinary income, and then therefore pay less taxes at the end of the year.
Yeah. And I guess as part of this, there's the tax harvesting. And I think it's important for a lot of people to understand that this is actually different than the traditional one. When I talk to a lot of traditional investors, they basically say, oh, there's something called wash trading, or kind of the loss at the end of the year. You can't have a loss on unrealized an Amazon stock, let's say for the year, December 30th, sell the stock, and then just buy it back January 1st or 2nd, right? That wouldn't count as the actual tax harvest of the losses. Here in crypto, that's different. Maybe kind of explain like why that is.
Yeah, so this is the kicker. This is why it's super interesting in crypto specifically. So as you mentioned, normally there's wash sale rules that make it so that basically the IRS says your loss is disallowed if you buy back the same asset 30 days before or after the disposal. So with, let's say, the Amazon stock example, if you were just selling the Amazon stock at a loss and then buying it back right away, you wouldn't be able to claim that loss. And the idea there is, you don't want people basically taking advantage of this tax loophole. What normal financial advisors would do in this scenario to still allow you to do this is either wait 30 days so you get beyond that period, or find another asset that is sufficiently similar in terms of your diversification of your portfolio to replace that asset with. So typically it would be if you have one ETF on, let's say Vanguard, that you're then selling and then buying back a similar ETF on Schwab instead, so that your overall risk allocation is the same, but you can still take advantage of not having to get your wash sales disallowed. In crypto, the reason why it's different is because the wash sale rule is specifically written in the tax code for securities. And because Bitcoin and other cryptocurrencies are classified by the IRS as property, they don't fall into the wash sale rule. Now, there are some exceptions. Some people would argue that certain cryptocurrencies are security tokens, or the SEC might rule that certain long tail coins are clearly securities. And so for those, they may fall into the wash sale rule. But for Bitcoin, it's clear. Bitcoin is not a security. This would not apply to it. Ether is also likely not a security. This would not apply to it. So for like these head coins, you can basically take advantage of this loophole that doesn't exist for let's say stocks, for example.
Yeah. And like, how important is it? Let's say that I buy, 5 Bitcoin, but I buy them all at different price points over a period of time. And at the end of the year, or when I go to sell, 2 of them currently at a loss, but 3 of them I have a gain. Do I need to make sure that I sell the 2 Bitcoin specifically that have the loss, or can I just sell any 2 Bitcoin and then basically say, oh no, those are the 2 where I'm going to take a loss and the other 3 are fine? Like how important is it to get the exact Bitcoin?
You're now getting into a advanced but really, really useful topic that people can use to save a lot of money. An accountant's dream. Basically, what you're touching on is different kinds of cost basis accounting methods. And the IRS typically requires people to use one of 2 different methods. One is first in, first out, meaning the first coin you get is the first coin you sell. So if you bought 5 Bitcoin, Bitcoin number 1 that you got is the Bitcoin number 1 that you sell. They also have a more advanced method called specific identification that is also allowed. And in that method, it's kind of like what you suggested. You can pick exactly which Bitcoin you're disposing of, as long as you meet certain criteria, like keeping detailed records of what date and time it happened, which coin it was, which wallet it was coming from and going to, what the timestamp, what the basis was, etc. And all of these are things that CoinTracker would help you optimize and create records for. And the difference between kind of using FIFO versus doing some kind of optimization here can be huge in terms of cash flow and in terms of tax optimizations. Because if you bought, again, 1 Bitcoin at a really low price and then got another one later at a very high price, you definitely are going to have a massive tax difference in terms of which one you dispose or which one you trade for altcoins.